Welcome to FreightWaves Today. It is Wednesday. It is AAR Day. We're going to find out how the state of the industrial economy is rocking and relling. Julie, I always talk about this being my favorite day of the week. It tells us the truth about demand. We've talked about it on the show, is everyone feels that demand in terms of the overall freight economy is good. Maybe not as great as what it was, but we've talked about why that is. Intermodal is that. Bloomberg's chief economist also retweeted me last night about the fact that they're also seeing this in their earnings reports, that the modal shift into intermodal is certainly something they're picking up. There is no slowdown in the economy.
No, and I talk a little bit about that in the Sonar update, and really that actually demand has stopped falling, and we can see a bit of a rise since August 8th.
Yeah.
And then in one of the headlines, we're going to talk about a new interview where some quotes from Derek Leathers from Werner talked about he thinks it's normal, seasonal, and it doesn't change anything about what they're seeing regarding available capacity or demand, and that he has no doubts that we're still in an incredibly strong freight economy.
Yeah, anyone who doesn't track the industrial data may think things are soft. There's a lot of sort of noise on X and in the brokerage community about a slowdown, but it's not what the data is saying. All of our channel checks are incredibly strong. Consumers are holding their own. I think yesterday was an interesting conversation. You weren't here, but we got the chance to talk about the retail peak season, the fact that it's early, imports are flowing in early, and companies are doing summer wean. Did you hear about this?
I did listen and watch the show, even though I was working from home yesterday, and I did. And yeah, listen, it's like all the
Halloween
ladies like
early?
me. I'm not like super into Halloween, but like
my kids are.
Yeah, I'm into it for my kids.
Yeah.
But I'm not one of those people who like goes all out Halloween decorating. I like to decorate for fall, but yeah, it's totally a thing. Summer week, like the minute it's like we get through 4th of July and back to school and it's August, people are like, all right, let's get into fall, let's get into Halloween. They start
Halloween
planning
candy
and
is a
getting
weird
excited.
thing to see. I get, it seems like what we talked about yesterday was the fact that there's like this movement ahead to the season because they're always afraid to basically be out of inventory. And it's interesting, growing up, I didn't feel like Halloween was that big of a deal, but it feels like retailers have caught and understood how big of an opportunity it is. Particularly, even like Home Depot sells these skeletons that apparently like sell.
I want one of the chickens. There's like a skeleton chicken from Tractor Supply. I think it's hilarious.
Got it. I don't know that I've seen one of these. We got to find maybe production could find a skeleton chicken thing. We're going to talk today about energy and the state of the energy market with Tom Kloza. Tom was the co-founder, I guess you're always a co-founder or founder of Opus, but now he's with Gulf Oil. He's the chief energy advisor. He's going to tell us what he's seeing in the oil market and the energy market. We've got Patrick Kelleher. He is the CEO of GXO Logistics to talk about the state of logistics, warehousing, global logistics, all of that. Of course, Bill Stevens is here to talk about the rail freight and what we're seeing. And then Jeff D'Angelo's got a major announcement that he's teasing. We're going to hear he's the CEO of Fura, which is a roll-up using AI to roll up freight brokers. So welcome to FreightWaves Today. Let's get into the headlines.
We kick things off in Washington, where lawmakers are aggressively tying executive pay to actual delivery performance at the struggling Postal Service. A bipartisan bill barring U.S. Postal Service executives from receiving bonuses until on-time mail delivery levels reached 95% was approved by the Senate Homeland Security and Governmental Affairs Committee last week. The No Bonuses for Bad Service Act, sponsored by Senators Josh Hawley and Richard Blumenthal, comes as the Postal Service missed its on-time target for all 8 mail delivery categories in fiscal year 2025, with none hitting the 95% threshold. The mail carrier has lost $25 billion over the last 3 years and reported a $2.5 billion loss for the third quarter. Postmaster General David Steiner, who has already received a $170,000 bonus, despite taking office just a year ago, urged senators to reject the bill in a private letter, warning that freezing bonuses would be counterproductive and limit the agency's ability to attract qualified executives. Over in the truckload sector, Werner Enterprises is shrugging off recent spot market softness and doubling down on the supply-driven recovery. Speaking at Deutsche Bank's Chicago Industrial Summit Tuesday, Chairman and CEO Derek Leathers told investors the company remains unfazed by the seasonal slowdown in July truckload spot market trends. Leathers estimates that 850 to 900 CDL schools have been forced to close due to insufficient training standards. in addition to roughly 10,000 training programs removed from the Federal Motor Carrier Safety Administration's training provider registry. The massive capacity constriction has powered Werner's turnaround, with the company's one-way truckload fleet seeing revenue per truck per week jump 28% year over year in the second quarter. Werner expects one-way rate per mile to increase by 10% to 13% year over year in the third quarter and projects a path to low double-digit margins during the middle of the freight cycle, which could occur next year. Finally, state regulators in Michigan are joining the nationwide crackdown on fraudulent CDL training programs. The Michigan Department of State issued a summary suspension to Northern Michigan University Truck Driving School on August 5th, following an investigation that uncovered multiple alleged violations. Among the most significant allegations, regulators said the school provided behind-the-wheel instruction to students without first verifying that they possessed valid commercial learner's permits. The school also allegedly failed to maintain records required by law, kept records somewhere other than its established office, and allowed students to sign blank instructional documents that were subsequently completed. The action comes less than a month after the Trump administration announced an expanded federal crackdown, with the Federal Motor Carrier Safety Administration identifying approximately 75 entry-level driver training schools suspected of fraudulent activity.
So, Julia, the headline on the U.S. Postal Service is really interesting.
It's a mess.
It's an agency that is struggling to make a profit, but a lot of it is because it is required by federal law to do two things. One is the pension. They have these pension payments that they have to make to the union. They also have to deliver to every single house 6 days a week. And so it creates significant problems. I think they need to reduce some of the schedule for weekend deliveries. Do you think the Postal Service should deliver every day? Because one of the most efficient things it could do is cut out full everyday delivery to your mailbox.
Do you think people care if they get mail every day as long as their packages are coming quickly?
I don't think so. And I think there's alternatives for package parcel delivery.
What do we still get via mail?
Look, magazines, you get periodicals, you get government notices.
But if you knew that was coming the second Wednesday of every month.
Would it matter? I don't know that it does. And I think it's an interesting conversation.
And maybe some things would be the exception, like car registrations, things you need right away, then you pay for
okay, what if it was twice a
specific
week?
delivery.
What if it was twice a week? Why does it have to be every day? I mean, with email and proliferation of parcel, people want their packages.
That's what I mean, yeah.
But you certainly, and parcel delivery could have its own sort of network. But again, it just strikes me as the idea that you have to deliver to every U.S. address under federal law and do it as often as you do it means that there is opportunity for optimization.
And I didn't hear the conversation yesterday, but there was a story about changing zip codes yesterday and the impact on the Postal Service too, right?
Yeah, look, the Postal Service they're going to be out of money in 2030. And the question is, what is that worth to the U.S. economy? Is obviously the Postal Service provides an enormous utility to the U.S. economy. Without it, but there are an enormous amount of opportunities to optimize it. The problem is every time you do this, when we had the last postmaster right during Trump's original sort of re-election in 2019, there was a lot of noise because they were trying to fix the overall logistics network, but then had the problem of it becoming, well, is this because of the election? Do you remember all this noise? Probably not. It was complete nonsense. But it's just a polarizing thing. And the problem is when you have to do it publicly, you have union special interest, you have government special interest. It makes it hard to do.
Yeah, I think it makes it really hard when you have to service, to your point, every location every day. And I also think there's a lot of
but there's places in Alaska.
I will tell you that I saw on my drive home from wherever I went yesterday afternoon, or maybe it was the day before, as I was pulling into my neighborhood, late afternoon, early evening after work, I passed 2 mail trucks in my neighborhood at the same time, doing different things. So they weren't on their standard route. Maybe they were delivering packages, so it was their second run. I don't know, but there's a lot.
Well, there's also, they had this contract where they use, it's been bounced between FedEx and UPS, and they're not putting enough volume in parcel where they're actually putting just first-class mail onto some of the belly, into some of the air cargo because they have all this excess capacity.
They bought too much air cargo.
Yeah, they bought too much air cargo in these contracts. And so it's a really interesting conversation because you've got to look, I think the question we have to ask as Americans is how much how much pain, financial pain, can we tolerate? And look, when you look at the size of the federal budget, we're talking it losing billions of dollars, and I think everyone looks at it from the lens of a business. This is, doesn't have the same freedoms that a normal business does. It has mandates by Congress that creates an enormous amount of issues. Not to mention, anytime they talk about shutting down a post office, or anytime they start talking about layoffs or trimming back schedules of delivery, you get an uproar. And again, it's about the fact that this is a government agency that. And again, I think the question is what is the U.S. consumer willing to give up, and what is Congress willing to allow? Like, postal services, and this has been a conversation, in other countries have been spun off, private businesses. I mean, that's, if you look at DHL, that was the Deutsche Post business, the UK, the Japan, they own the bank system. So there are these things that you can do to make it sustainable, and there's a model for that. But again, I think it goes back to the fact that in addresses in Alaska and Hawaii, in Guam, they still have to deliver to all these addresses in these really remote parts. And that is where the predominance of the losses are coming from.
Yeah.
It's too expansive a schedule and delivering to every house, even when it's not profitable.
So look, the other headlines, I mean, there's a theme, right? In its continued capacity exiting the market. And I talk about in the center update the number of net carrier details, right? Operating authorities. And it's a little bit misleading, but obviously we're hearing the FMCSA continue to crack down on fraudulent CDL schools. We have the example in Northern Michigan. And then on the Werner story that, yes, there's a bit of normal seasonal July slowdown, but they still saw a 28% year over year increase in in revenue per truck per week in Q2, and they expect rate increases of 10 to 13% in Q3. So I think it's all good. One thing that I did notice is it sort of alluded to the idea that they think we will hit the peak of this freight cycle mid next year. Do you agree with that, or do you think it's going to be longer?
It's a hard question. It's a hard question because we don't know. And the fact is, I think that is Jason Miller's argument, is that it will peak next year because new entrants will come in, new expansion. I find it hard to believe that we're going to find a new source of truck drivers, which is really the capacity constraint. And so while I don't want to get ahead of myself, because inevitably we always do this where we say, oh, this cycle is going to run a lot longer. The reality is the entire capacity question is going to be driven by driver availability. And where are you going to find drivers? That's this immigration thing is definitely an overhang in capacity expansion. This compliance crackdown is an overhang. Fleets are having to pay up. Even if you look at the employment numbers are not growing in transportation jobs. John Kingston talked about this, that we have the same number of transportation employees that we had in February. So where are these drivers coming from? And that is, if I'm making a case for a stronger, longer duration bull market, it's all about driver availability. So speaking of commodities, there's no more commodity that's tracked than oil. And the person to talk about oil and tell us the state of the energy market is Tom Kloza. Tom is the Chief Energy Advisor for Gulf Oil. Tom lives in New Jersey. He's joining us today from New Jersey. Tom, welcome to FreightWaves Today.
Hi, nice to be here.
Well, tell us a little bit about the state of oil as you see it. Obviously, this has been a pretty eventful year, maybe one of the most eventful years. Although I know you do this, and every time there's a crisis, people talk about how unprecedented the crisis is. It feels like. What would you rank this crisis in terms of the impact to energy?
Well, it depends on what product. For crude oil, I mean, we've never seen anything like it. But right now, I would say the biggest focus in the place where the media really isn't focusing is on diesel prices. We thought we'd never see prices as high as they were during the first few months of the Russian war against Ukraine, but we're seeing them now. And, we saw Energy Department information released today, and it's pretty scary for diesel going through the rest of the year. I like to say, I like to do a lot of presentations during the year And the motivational speakers get the money. I get bupkis because I'm there to bring people down these days.
Well, you and John Kingston, our own energy reporter at FreightWaves, have been. John talks about how he believes that particularly diesel prices, these refined product prices, are going to go up, and he has made that case. Sounds like you're also in the camp of we're about to see a big surge in diesel. Is that the correct read?
Yeah, I think everybody focuses on gasoline because gasoline, people react to it the way I react to the Dallas Cowboys. It just annoys the hell out of me when they win. And people see those prices and it annoys them. So it's got this tremendous visceral reaction. But diesel really powers the economy. And it's not just the on-road diesel, it's the marine diesel that the ships are using. And these prices are really, bordering on insane. And were we to get a hurricane in the Gulf of Mexico, not even a hurricane that hits refineries, but just threatens them, we'll move the choke point from the Strait of Hormuz to the Red Sea to the Gulf of Mexico. And we could see really apocalyptic numbers for some of these fuels.
So let's talk about what does an apocalyptic number mean, Tom, and related to diesel. So, we're well above $5 a gallon, according to the EIA. Where are we going from here? Like, what could it be if we have a major hurricane that threatens the Gulf Coast?
Well, let's talk about it in terms of dollars per barrel. Everybody knows crude oil is, somewhere in the 80s right now. The price of diesel is about $180 a barrel on world markets, not with tax, not with any addition, but just the wholesale spot price for diesel. And it could certainly go above $200 a barrel if we had some sort of tropical disturbance in the Gulf of Mexico. And the United States is actually in great shape. This morning, you may have seen it, we exported almost 2 million barrels of diesel, distillate they call it, but it's mostly on-road diesel. We exported that much to the rest of the world last week, and that broke all the different records. And it means that in addition to, let's say, 3.5 million barrels a day of domestic consumption, we've got a market for almost 2 million barrels overseas. And the U.S. Gulf Coast, like it or not, is the cleanest dirty shirt in terms of places to find that product for the rest of the world.
Well, it's also, I've made this point before, is the Americas, and I use that term broadly, not just the United States, but the Americas is the only non-contested place that isn't in a conflict zone where you can get energy supplies. That strikes me as good for the economy. I mean, price and price risk, particularly for our audience of people in freight, is certainly an important conversation. But there's also the element of the demand side, which the United States is unusually in a place to provide some of the bumper capacity for the globe. Is that not good for the U.S. economy?
Oh, I think it's very good for the U.S. economy, and it's great for the trade balance. That does not mean that the Trump administration won't raise the specter of possible export curbs to temper prices. I mean, this administration has proven that, they can influence crude oil prices. Crude oil prices would probably be well north of $100 a barrel, but for all of the Trump interventions on Truth Social. I would not be surprised if they didn't raise the specter of possible export curbs just to try to cool some of the buying enthusiasm for diesel. It would be a horrible policy outcome, so I don't think they'd pursue it on that score. But don't be surprised to hear it mentioned on some of the platforms in the next few weeks.
It's always fun watching the noise on X, which is, on Friday nights, they love to go ramp up the attacks or at least the threats. And then by Sunday, right before the futures markets open, it's all, hey, we have a peace deal. And it is interesting watching it because there's so much market manipulation by the administration. As you point out, it's unusual. But the problem of doing a diesel ban, and look, it's not unprecedented, we've had it before, is that you effectively are going to drive prices to the floor for U.S. diesel that really doesn't help these refiners in terms of investing for capacity. What are your thoughts there?
Well, I mean, right now the world is short refining capacity. It's short probably 7, 8, or 9 million barrels a day. And one of the reasons it's short, and people don't realize this, is there's a genie that's been let out of the bottle in the last few years. And that genie is drone attacks on oil infrastructure, on some logistics, but mostly on refining. In the last week, we had drone attacks knock out refining in Russia. We had a knock out a refinery in Saudi Arabia. And I think a couple of days ago, there was a refinery in Libya. If that spreads, and even if it doesn't spread, it is a new game changer that really tightens the spigots for refined products output. The other thing you have to consider is, what you talked about the Americas. The Americas are very, very dependent on U.S. diesel. Latin America, had much more refining capacity 10 or 20 years ago when Venezuela wasn't in, this decrepit state. And the United States is basically the supplier to Latin America, South America, and, to the rest of the world. So, the problem is if you need diesel to sort of justify your business or to, run your business, you're going to be paying more for it for all of these reasons.
Tom, it is breathtaking to watch these drone attacks, not just refineries. I know that's a world that you care deeply about, but even these logistics warehouses in Russia where these things incinerate so quickly. I mean, it is absolutely, as a middle-aged dad, I spend my weekends watching YouTube videos of everyone, they say when you get to a certain age, Julie, as a dude, as a dad, you end up watching videos of war. Like you
Really?
pick your war. I'm very intrigued by this whole drone, Ukraine, Russia, and really, overseas. The interesting thing though is that at least documented cases, we don't know yet of any actual drone attacks on U.S. refineries. Is that inevitable going to happen?
Yeah. I tell you, that is something that keeps me up at night, not just in the U.S., but in Europe. And, Putin made some comments earlier about some of the drones that they've captured from Ukraine and using them, against European cities or whatever, which is pretty frightening. Think about it this way. I think it was, in the Civil War, they came up with the Gatling gun. That was a big game changer for warfare. The drones, you can buy drones or you can build drones for tens of thousands of dollars, and they could knock out billions of dollars of petroleum infrastructure. A refinery is essentially a powder keg. So you don't need much in the way of ordnance or payload to really knock them out. And we're seeing that across the world right now, but particularly on the other side of the world.
But Tom, what are these refineries doing? I mean, I've seen some of the United States military, the Department of Defense got $50 billion for a new agency that is doing drone, both building an offensive capability, but also defensive capability. Certainly the DoD doesn't move fast, except when it's sort of, when you have this sort of asymmetric warfare element here. But what are these companies doing? Are they investing? Because it feels inevitable to me.
That's a good question. I think there's a lot of investments in the construction of drones. You hear about Ukraine and how many drones they're making a month, and it's pretty impressive. As far as defending against them, that's something altogether different. Now, if you go to a baseball game and you see the netting that prevents people from getting hit by foul balls, they've actually tried things like that in Russia to protect some of the refineries, but as you can imagine, that doesn't do it. So I don't know what's going to happen.
It is interesting looking at
that. I have seen the videos of that.
The thing is, Ukraine's gotten so innovative, and it's interesting how this country that's in innovation is the mother or
necessity.
Thank you.
Gotcha.
Necessity
is the mother of all innovation, or something like that.
I didn't sleep last night. We had a major storm.
We had a bad storm last night.
Down in Tennessee, Tom.
But most of the innovation is offensive. Most of the innovation is offensive. As far as defensive, we hear a lot about Patriot missiles, but I don't know how you stop a $10,000 drone, particularly when there's 600 of them being lobbed against your facility.
I did see this weekend. Did you see this? Yeah, the swarms are interesting, but did you see this weekend Donald Trump was in Bedminster up near Tom golfing, and they had a military. It was like know what you call it, but it was there to protect drones. They actually put it right by him
Protect
when he's
against
golfing.
drones?
Protect against drones. I guess it's probably a microwave thing that was protecting the president. But he's out golfing, and he's got this major, Humvee with these, looks like microwave things that they could shoot him down. And like, this is a story in
Let's
New
just hope
Mexico.
that
New Mexico of
let's
the
hope
U.S.
that
Army
the
testing
instruments
these.
that they use have greater precision than the way he keeps his golf score. So that would be
We'll
one
let
of the
you say
worries
that,
I would
Tom.
have.
But it's interesting because now you're having to, everything's changing.
Everything is changing.
And
yeah.
but I think it's
Yeah.
interesting because it's asymmetric warfare. Taiwan is paying attention, but think of we've talked about this before, is that supply chains are, we're on the front lines. This is really where it's all taking place.
Yeah, but I think drone warfare will be with us for long after the Strait of Hormuz goes back to some sort of sense of normalcy. And that really has an impact for refined products and for, petroleum and petrochemical operations. And maybe the answer is something like the cone of silence from Get Smart, or maybe, something from Star Wars with laser defenses, but it's not out there yet. And that raises some pretty big concerns.
The issue, and they did this, I believe it was in New Mexico, where the U.S. Army was testing anti-drone microwaves. And there's a story, it's a lot of dispute in the aviation circles about whether this has actually happened, but there's a belief in certain narrative that an airplane crash, a U.S. civilian aircraft crashed because of one of these microwave tests that took place, because this plane effectively fell out of the sky. And so it was near a military base where this testing was taking place. And the problem with these microwave defense weapons is they're indiscriminate. I mean, their job is to protect the skies and everything, including aircraft. And so, I mean, Tom, it strikes me that this is a whole new world. As you said, you can't put the genie back in the bottle. It's irreversible, no different than bunker warfare and aircraft. And you look at every major military conflict, there's been some innovation that we've just been stuck with. I don't know if that's good, but that is the way it works.
Yeah, it's pretty frightening when you think about petroleum infrastructure and you think about how flammable it is all over the world. Is the electric grid as vulnerable? I don't know, but I do know that, for the first 48 years of my career, I never heard about a refinery being attacked with drones, and in the last 2 years, it's been happening in spades.
So, Tom, we talked a little bit about, the scary diesel situation and that prices, are likely to rise. But can you step back and tell us a little bit more about details about current diesel supply, and then how exposed is the U.S. to that diesel tightness with its own supply versus sort of the rest of the world? I think you mentioned that we're in pretty good shape compared to what we have available to export, but just sort of big picture overall diesel supply.
Well, the root of that is the capitalist system. And right now, if you manufacture diesel at the refinery, you're going to get $90 more for your diesel than you paid for the crude oil. So there's the incentive to make as much as you can. Problem is, the United States could make maybe 5.3 million barrels a day. And if domestic demand is pushing 4 and foreign demand is 1.5, you can really run into problems there. So they're certainly motivated. They can make a lot. The question is for how long, and what happens when refineries have to take pit stops and basically, do much needed maintenance on their assets.
Tom, I should. When I started FreightWaves, PRA world, Opus was always an inspiration. It's probably the first PRA I was ever exposed to was Opus. Largely because when we were buying fuel at US Express, we were using the Opus floating index, and we've tried to do that for freight rates. Did you ever expect and see that PRAs would become as valuable as they are? Or was this an evolution of sorts, or going back to early in your career? You've got to be very proud of what you've built and the legacy that you've established.
Yeah, I mean, I have ambivalent feelings about it. I'm proud of what we started and that we brought price transparency to the markets. But, that price transparency has probably turned into a little bit of price translucence, where the numbers that get posted aren't necessarily the numbers at which commerce is taking place. So, that's a little bit of a disappointment. But in terms of the need for it, when we started Opus, we never thought we'd have clients who would spend millions of dollars a year for that data, but that's indeed what they spend these days.
Yeah, the valuations of PRAs, I'm sure, are somewhat shocking if you went back 30 years ago on how valuable these businesses have been for what the work that they do.
Yeah, well, that's the interesting thing about the oil business, and I've been in it for many decades, is it is so much more profitable than it was years ago. And it's more profitable on oil production because of technology. It's way more profitable on refining, and it's much more profitable on the street. The average gasoline margin in the last 5 years is about 40 cents a gallon, whereas it was 15 cents a gallon the first time we hit $100 barrel crude. So it makes sense that the PRAs and the people that are in the margins and in between all of these different big players are making more money as well. I just wish it was me and not the PRAs.
It is interesting, Tom. We like to watch the spread between retail diesel prices and
Right.
wholesale rack prices. And the spreads, of course, there's been this massive consolidation of the truck stop chains. Now you have three major chains that are really, in many ways, price setting because they have such substantial market share. But the spreads, I don't track the gasoline market, but we do track the diesel spreads, and just the amount of consolidation has enabled an enormous amount of pricing power among the major fuel stops.
Yeah, it's hard to fathom though. And one of the frustrations I had is that you look at the number and you see those big high prices posted by Love's or Pilot. And of course, you recognize that an awful lot of the fleets are buying at cost plus. But are they buying at the real cost that the truck stops are paying, or are they buying at a posted price? And there might be discounts of 20 or 30 cents in places like Denver. So it's become much more opaque, despite all the PRAs and their best attempts.
I was told by an insider at one of the major truck stops that only like 2% of the fleets are actually buying true retail price, which is sort of an interesting misnomer in the fact that this is the price that fuel surcharges are set off, is the DOE EIA,
They are,
EIA
yeah.
price.
Yeah,
And so
absolutely. It's crazy that the government fuel surcharges are tied to those numbers when so few, maybe a landscaper is paying those numbers, but certainly the big fleets are paying much, much better numbers. And the truck stops, and you've seen this proliferation of build outs of, new enters and travel centers, they're making out because they're buying at well under rack prices in these negotiated numbers.
yeah, it is really interesting to watch. But the fact that it's and what I was told by someone who knows this business, been around the fuel business for many decades, said it's flipped. In the last 5 years, it's really changed. Where you go back 5 years ago, there was a much larger proportion, particularly owner operators, that were buying at retail prices. They might have got cost or might have got retail minus. But now everything's shifted to cost plus, and that's been, or cost minus, depends on how big your fleet is. But that's just a complete change, total overhaul of how people buy it. And unfortunately, if you're paying a fuel surcharge, if you're a shipper, you're getting totally screwed by that.
Yeah, cost plus is very, very common, but the cost is something which is very equivocal these days. And the fleets are kind of the victims of that to a great extent. And certainly the consumers are, when you have these freight surcharges that are based on these numbers posted on high that really have no relevance.
I don't know many fleets that are complaining about the spread of diesel, just saying. Is they like that high diesel, that retail price and big spread. That's how they make their money on these fuel surcharges. Tom, really appreciate it. Thanks for coming in and joining us for FreightWaves Today. We'll have to have you back to get more updates on the diesel market, something to watch. Hopefully we don't have a drone attack to talk about.
Thanks for having me.
It's scary.
It really is scary.
Absolutely scary. We'll be back right after these messages with the sonar update.
The drivers, dispatchers, mechanics, and crews who keep the world moving deserve tools that work as hard as they do. That's what Samsara builds, technology for safer, more efficient operations, made with the people who do the work. Samsara, built with operators for operators. Learn more at samsara.com.
The world doesn't wait, so neither do they. Wheels on the interstate, boots on the site, hands on the shipment. We build for the world out here, and we build it with the people who live it. Ideas from the field, made real by world-class R&D to keep the operation sharp, the front lines safe, and the world moving. From one cab to a global network, billions of miles, trillions of data points, every one making your operation better. And we never build it alone. Samsara, built with operators.
Once a year, the entire freight industry stops what it's doing and comes to one place, Chattanooga, Tennessee. This is F3, the Future of Freight Festival. It isn't just a conference. It's the largest festival in freight, built to pull you all the way in. The energy, the ideas, the atmosphere, and the people who move this industry forward. Over 50 speakers, 4 events across 3 days, founders, executives, innovators, and disruptors, all under one roof, all asking the same question: what comes next? On the main stage, the sharpest minds in freight take on the biggest questions in the business, the trends, the technology, and the forces shaping what's ahead. Then the clock starts, 7 minutes, no exceptions. The cutting edge of freight tech goes head to head, live, battling for best in show. When the time's up, the lights go out. And in between, the conversations that don't happen anywhere else. The connections that change the trajectory of your business. The relationships you'll carry long after you leave. Because when the sessions end, the festival begins. Live entertainment, unforgettable experiences, a celebration of the world of freight, and an energy you won't find at any other event in the industry. The leaders you need, the access you won't get anywhere else. This is where knowledge is shared, where deals get done, where the future of freight gets decided. F3, Future of Freight Festival, October 27th and 28th. The Signal, Chattanooga, Tennessee. We'll see you there. Register now at live.freightwaves.com.
Welcome back to FreightWaves Today. Julie, Tom's conversation just made me think about all this drone warfare. And you gotta, if you don't spend time watching anything, these YouTube drone videos of these Ukrainian attacks on Russia infrastructure, logistics infrastructure. In fact, Zelensky actually tweeted that a warning to Russia is that if you attack our logistics infrastructure, we're coming after yours. And he's like, and he makes the point that they've mapped it all out. It's very scary. I do wonder, we're in the United States, we're well away from sort of military conflict, but I worry about a September 11 style attack using drones because it strikes us, whether we're talking airplane infrastructure, refining infrastructure, strikes me that we are incredibly vulnerable to these drones. And they're civilian drones. There's $10,000, $20,000 drones.
Yeah, I think it's terrifying. I think it's something that I don't want to stay up at night worrying about because there's nothing that I can do about it.
No,
but
I
I
know.
think that you're absolutely right that it is
There was
a huge
a
risk
couple years
to
ago.
infrastructure specifically, right?
Well, a couple years ago, there was a container that was moved into Russia, deep into the heartland. This is when the drones only could go like 10 miles. But they moved it deep into the heartland. And what they did was the container, all of a sudden, these drones flew out of the container.
like a Trojan
and
horse.
Exactly like that. And went and attacked airplanes, like Russian military aircraft. It's one of the biggest attacks, really targeted aircraft attacks in history. Really fascinating stories. We're going to keep following this story and others, but right now it's the Sonar Update. Joey's going to give it to us.
All right, for today's Sonar Update, Wednesday, August 12th, I want to talk a little bit about sort of the market as a whole and some indicators coming from some of the different Sonar indices. So tender rejections are remaining relatively flat. We're at 13.5%, which is back in line with what we were seeing in April earlier this year. However, demand has stopped falling. STVI, Sonar, Truckload Volume Index. When you look at the seasonality chart, it shows that we are still above the prior 3 years for demand. And when you zoom into just the last 3 months, we are seeing a minor uptick, especially since August 8th. So that's an indicator that demand is beginning to rise. So I wanted to take that a step further when thinking about demand and volumes and look at loaded inbound containers. So our IOTI index, when you look at it this year versus last year, you can see that since June, we're seeing an uptick in imports of loaded containers. We're not seeing the numbers degrade compared to earlier in the year like we were seeing. We're really seeing a broader peak this year, pun intended, both the peak here in the mountain chart, but also when it refers to peak season. So the uptick compared to last year is much longer and more and broader. It's more elongated. Again, especially when you compare it to last year where there was that sharp and shorter peak of imports around some of the tariff noise that was happening. So we're seeing more inventory and more containers come in at a higher number, but really over a longer period of time and a little bit more continued out versus all at once. So my question from this is, has enough inventory been ordered to sustain us through later in this season? Because when you look at the LMI inventory levels and compare them year over year to last year, we're down 9%. So that's certainly something I'll be continuing to watch. So then when I was looking at loaded container numbers, I wanted to dig into O-Rail and compare domestic loaded containers and intermodal volumes to international loaded containers. And it really further proved the point that we have been talking about this week regarding this mode conversion story, and that there's not necessarily less volume that we're seeing as tender rejections have fallen a bit, but that a lot of that volume is shifting to domestic rail. So the chart shows when you look at the last 2 years, that intermodal loaded containers internationally are down 13% in the last 2 years, while loaded domestic containers are up 7%. So if you zoom into that and look at just the last 6 months, still the same story. Loaded domestic containers are up 5%, with loaded international containers down 2%. So really, again, this is a story of mode conversion and intermodal rail having a moment domestically and really having the opportunity to continue to pick up market share and additional volume. So then I wanted to think about, rather than just demand, also capacity, as we're still hearing that capacity is certainly tight. We're still seeing those tender rejections around 13.5%, but we've seen a cooling in that in the last few weeks. So we just released updated CNDCA numbers, carrier details, net changes, and trucking authorities. And to me, those numbers were a bit surprising. The data shows that while there is a weekly net decline in trucking operating authorities through Q1 2026, beginning in Q2, there's been a relatively sustained uptick in more entrants getting operating authority than those operating authorities being revoked. Q3 to date, we saw a net gain of 1,996 operating authorities from the week ending July 3rd through the week ending August 7th. That number is 914 behind Q2's total gain of 2,910 operating authorities, but 1,596 ahead of a gain of 400 authorities in Q1. So we are seeing additional authorities come in as we enter the year and at a faster pace in Q2, slowing a bit so far in Q3, but we'll see. I think some of that Q2 peak could have been from some of the noise around the new tools and carriers actually getting registered and their operating authority numbers and all of those things. But to kind of put it in perspective, a total of 19,594 net revocations have occurred year to date, but enough capacity has entered to offset that net loss, resulting in a net gain of over 5,000 unique operating authorities. So my question there is, I don't think it's a massive amount of capacity entering the system. I think it's small carriers, entering, taking advantage of the healthier freight market with higher rates. But are these new entrants sustainable? And to me, I am struggling wrapping my head around how they could be. Are brokers still tendering freight to carriers with new MC numbers and no safety rating based on current fraud conditions, as well as certainly litigation and liability concerns? So while we are seeing an increase in some of these net authorities, I don't know that it's necessarily translating to more capacity being available. We'll continue to watch that through the rest of the year, as I do believe that demand will continue to rise and pick up a bit, and that there's not going to be a massive entrance of new capacity, even with some of these new operating authorities entering the market. I think they're going to have a very hard time getting freight. Certainly, shippers are going to be pickier about who they're tendering freight to. And if I were a broker, I would be incredibly picky about who I am tendering freight to right now and ensuring that I have covered all of my bases. So we will be watching through the end of the year as we expect demand to continue to rise as we get closer to peak, and we will see what happens with break check at the end of August, and what that does to capacity, and if it's a very short-term rise in tender rejections and decline in available capacity, or if that is sort of the beginning of kicking off another really hot cycle.
Okay, so one point that I do want to make a little bit more clear regarding the net carrier authorities, and if you can pull up just the 1 year graphic again, if you guys have it, you could see that there's a big peak there towards the back half, the green part in June.
Mm-hmm.
And I want to be clear that I think some of that was backlog, right? With the MODIS transition.
The MODIS challenges.
We got no data from May 16th until June 5th.
You couldn't even register.
There was no,
registrations were a problem.
So I think some of that peak that's this year, which is the part you can see in green, that surge on the right-hand side is primarily around that and catching up from that time when it was down.
It does maintain growth, but it's important to know that if you go back pre-COVID, when the industry was adding 250 fleets a week, like this is not unusual to see growth. That does happen. So
that graphic is perfect, guys. That exactly what Craig was talking about. When you go back further, when you look at 5 years, there was massive growth.
Well, that was COVID, but you go even, we've had contraction. I think we're in a stable market.
Yeah.
I call this a stable market. The fact that the market is responding to normal seasonal calendar inputs is just telling us that the market is stable. I don't see the case for continued increase in capacity because you're not able to find drivers to fill the seats. That even if fleets wanted to expand, we've heard this consistently, is that they're having to pay more for drivers. The driver environment is getting harder and harder. And that is going to keep the cap on capacity.
Yep, I agree.
So
I don't know where the driver market would come from, right? I mean,
where are they going to come from?
It?
I mean, immigration has been the big relief valve. The BLS data says as many as 20% of drivers are non-U.S. born immigrants. Insurance companies, and that was, I think in 2019 was that data. Insurance companies have told us that the number they believe is as high as 40% of the driver population are first generation immigrants. The question then is where, if you have immigration policy changing and tightening of immigration standards and compliance standards, because the source of those folks were non-registered, where is the capacity going to come from? It's not coming from, there's an aging truck driver population that continues to put a sort of governor on capacity. I just don't see the case.
Yeah.
And that's why I don't know that I agree with, I think it was Derek Leathers who talked about, thinks that the cycle is going to peak next summer. For his sake, I hope he's not right, and I don't believe it is. I think this cycle could go on longer simply because I don't know where the capacity can come from. Especially if you start to see we're going to get industrial data here shortly with Bill Stevens and the AAR data. There's been this expansion and broadening of ISM going beyond just the first couple categories and beyond data centers. So then the consumer activity starts to pick up again. Housing comes back. Auto starts to ramp. You could make the case that the cycle could go a lot longer than the next year.
Yeah, I think we'll have to see what happens.
Because
with
this is,
demand.
as everyone says, it's a supply-driven contraction or supply-driven tightness and not a demand one. Although the industrial sectors do look like they're showing some promise.
Yep, I agree.
Well, our next guest is on the front lines of this and has talked about it in their earnings report. We have the CEO of GXO Logistics, Patrick Kelleher. Welcome to FreightWaves Today, Patrick.
Thank you. Great to be here.
Well, glad to, man, you got a logos behind you. These are proud logos that you guys are sort of scalps that you've got. Is that what we're looking at?
Absolutely. Great customer logos. GXO serving amongst the best brands in the world. We love to show it off.
Amazing. So you've been very constructive about the economy, talked about how strong North America is for GXO. Tell us a little bit about what you're seeing right now in the market.
Yeah, I think based on what we're seeing, particularly on the maybe touching on the retail CPG e-commerce space, we're seeing a very solid build for peak season. I think hopeful for good volume there based on how our customers are behaving, albeit that in the aggregate, our consumer-facing industry verticals have been relatively flat on volume. We think we will be at or better than last year on that front. On the B2B verticals, we're seeing great volume on defense and aerospace. And as we know, the aerospace industry with significant backlogs there, we expect that to continue. Defense for obvious reasons. We're seeing substantially accelerated growth in our technology sector around our data center solutions, where we support the forward build of data centers as well as the maintenance and sustainment of data centers. And that volume is up significantly, and we see that going well into next year. Solid volume on life sciences and very solid volume on industrial, particularly as we're seeing redomestication of manufacturing become a true reality. And so generally for us, overall, have a really positive outlook to the end of the year for how the industry verticals are performing.
So
Craig, it's like you and Patrick are singing from the same hymnal. So.
I mean, we're
Yeah.
Look, the data doesn't lie, Julie. That's the great thing about freight data is it tells you actually what's moving across the economy, and you guys have a front row seat to it.
Yeah, and we do. And it's so great to be able to collaborate what we're seeing and what you're seeing as
So
reality.
I want to talk about
That should be encouraging.
I want to talk about AI data centers because this is always a hot topic for people. And it's becoming a very polarizing topic, unfortunately, for a lot of people, a lot of communities, a lot of misinformation that's driving this. But the thing that I think is on the mind of anyone who's in freight that sees the demand being driven by AI data centers is how sustainable is it? You know, the sort of conversation about a bubble bursting is going to bring it all down. I'd love to get your thoughts on how sustainable do you think AI data center construction growth is going to be over the next couple of years? And do you think it's going to sustain itself into 2030 and beyond?
Yeah, sure. I'm subscribed to the statistics that are out there that data center capacity is going to triple by 2030. I believe that because if I look at GXO as just a small $13 billion revenue organization that is part of a bigger economy, our focus on AI and the application of AI in our business is one of our top priorities, and I only see it accelerating as we go forward. I think that is true for the economies as a whole. We saw that with the announcement of NVIDIA's $500 billion investment through the consortium of banks that they've lined up. So I think the investment continues in the space. For GXO, we're supporting the build. We don't select where data centers go. We're not participating in some of those issues that you call out as it relates to power and location. That's for the hyperscalers to sort. And I do think, by the way, they will sort it out, particularly as it relates to power. I think there's a lot of great solutions there that are in play. For us, we're supporting the build, and there is a tremendous amount of activity there, and I think that will continue well into 2027. And we're most happy that our services support the maintenance and sustainment of data centers. So from a supply chain revenue perspective, that revenue has longevity, as I don't see the demand for data center capacity diminishing even into 2030, 2035, as you suggest.
So, Patrick, I think that I've read, obviously, you all help stand up those data center operations. I think I read that you can do that in as little as 30 days. Can you talk a little bit about the speed you guys all provide regarding that and how that process works and the role you play?
Yeah, sure. You did read that, and we are able to help our customers stand up data centers very quickly. And one of the unique things we've done is we've taken a lot of the rack assembly wiring out of the data center, where that can be a pretty tightly cramped area to be working in, particularly when you're building racks, wiring racks. And we've moved that activity off-site in a very production line assembly process, which is more efficient, lower cost, and we're able to execute much more quickly. And it's really served to be a great solution. We're also able to build for multiple data centers out of the same facility. So that's really served to be a great innovation to help accelerate how data centers are built out.
I'd love to hear a little bit about your investments in humanoids, I think is the term that you guys have described. This watching Elon Musk with the dancing robot thing, the Tesla robot, I don't know what they call that thing. But you've talked about the fact that this is coming. How are you guys leaning into robotics inside the warehouse?
Yeah, overall, we continue to lead on the agenda of robotics, automation, AI, and I think now humanoids. We've had over 45 pilots with humanoids. We have another launching in Europe in the second half of this year. We see ROI with humanoids in 2 years. And specifically there, the cost of humanoids will continue to come down as manufacturing increases. We see the cost of a humanoid being half the cost in 2 years is what it is today. Operating costs is coming down as well. So we're between $10 and $15 an hour operating costs. We should be sub 10 in 2 years. We don't know the depreciation curve on the capital yet, but safe to say total operating costs will be $15 to $20 safely in 2 years. Achieving ROI is really about getting the humanoids to achieve a level of productivity that eclipses what humans can perform at. That's important to achieve the ROI on the dollars and also to keep consistent flow in the warehouse and producing the volume. The humanoid solutions that we have in place right now are working. We have humanoids picking cosmetics, apparel, and so forth very successfully. We're working with our partners on increasing their speed. And AI is a huge part of that because the AI is the training engine for the humanoid. And so driving productivity up, I think this is a very viable solution that has a lot of efficacy for warehouse application in a couple of years.
So the big question that I have on all of this is it requires power and generation and electricity. If you're going to have electric warehouses, humanoids, drones, all of this, there's always a competition for power supply. When you guys are evaluating new site expansion to expand into this, how much is energy and electricity factoring into those conversations today?
Yeah, I think for us, we're not a power consumer like a data center would be. We're powering a lot of equipment in our warehouses today, 40% of our warehouses with high fit out of robotics automation today. So the power equation for us with the introduction of humanoids or more robots in the warehouse has not been a challenge. We are working with some unique partners who have alternative power solutions. I think that will come into play 5-6 years from now. So that's not a big driver for us.
So it's not really a factor. I guess the humanoids are not consuming as much power. These other much bigger demand on power because that's always a
correct.
It's always
and I think with the battery solutions that continue to evolve that are really efficient, we're really not concerned about that as a limiter.
So I'd love to hear you open the comments about reindustrialization's real. It's happening. Give us some examples of where you're seeing that.
Yeah, so we have customers that are providing parts and materials to infrastructure build. That could be large buildings, that could be infrastructure of pipelines, for example, turbines, and that activity. So the industrial segment, particularly in support of construction or in support of power generation, as you referenced, that volume continues to accelerate. We're also seeing interest from customers on repositioning their supply chain as manufacturing is coming into the U.S. So working with industrial companies who are manufacturing overseas now, shifting to a domestic manufacturing strategy, the location of their warehouses, logical location changes based on the establishment of that manufacturing capacity in the U.S. So instead of bringing product in through the West Coast or East Coast ports, that's being produced domestically. The location of warehouses changes, the transportation lanes change, and we're a big part of helping them navigate that.
One of the things.
So are you seeing a large shift from the coast to more the center of the country?
Yes. Yep.
That's what the data says. We've talked about it consistently. Even JB Hunt's intermodal, one of the sort of takeaways from their intermodal beat was the fact that there's a shift in the lanes into the center of the country and really the east, not so much dependent upon that transcontinental.
Yeah, I think that's fascinating. And I think for the increase of rail and particularly intermodal and what is coming in from the ports is more raw material than finished goods. So I think you're seeing more product that is a great fit for those JB Hunt-like intermodal services where finished goods that are landing in a warehouse on the West Coast in California, it may make more sense to move that by truck in the volumes that they're going. So that will be interesting to see how that evolves.
So is it moving to the Rust Belt? Like, where should I be buying real estate if I was going to be speculating on what is the real beneficiary of reindustrialization? Is it the Rust Belt? Is it the South? Like, where are you seeing new activity that you guys didn't see before?
Yeah, I don't want to give away my personal real estate insights there, but I would say southeast and kind of mid-southwest is very popular. So as you would expect, Texas, Georgia, even a little bit of Florida. Phoenix is a big market. Salt Lake City, a big up-and-coming market. The big West markets of Indianapolis, Louisville, Columbus, Ohio. I think those are all going to continue to build out based on what we're seeing.
Now, Patrick, you didn't say Tennessee. We got to root for the home team here.
Absolutely. I've got the Tennessee Orange right up behind me there. So, yeah.
So talk a little bit about security has been a big topic. Earlier, we had Tom Kloza, who is with the Gulf Oil, talking about the threat of drones. We've seen the attacks in international. Obviously, these are conflict zones. Are you guys having to do anything, think different about security than maybe you did in the past?
Not at this point. We're as a warehouse operator, we've got great security plans in place for the infrastructure that we operate. We don't operate in the Middle East, which is a particularly challenging environment presently. I will say on drones, we're on the side of supporting the supply chain of drones in the aerospace and defense activity that we're doing, and hopefully that's our contribution to the security of the infrastructure that we have and that the rest of our communities enjoy.
Yeah, I imagine it's a big
I wanted to actually ask specifically about that. That's where I wanted to go next. So tell us a little bit more about that. Really A&D, Air Force and defense portion of your business, how you're seeing it grow, where you're seeing it grow, where the demand is coming from, and why it's such a focus for you all.
Yeah, sure. So when I joined GXO a year ago, I embarked on almost 70 facility tours. And one of the operations I went in Atlanta for a large aerospace customer that I saw services both the commercial side and defense side of the business. And I found phenomenal operating capabilities, completely certified to handle everything that the U.S. military needs as well as what commercial aviation needs. But I hadn't seen a big effort on GXO's part to grow in that area. And so we've really doubled down on our efforts in aerospace and defense. I formed a Defense Advisory Board in February of this year. We announced that publicly. So we have former military folks who are senior in the military, many of them out of the supply chain side of the military, who are advising us on the best way to stitch together solutions that we have that really address opportunities and challenges that exist in the defense space. And that is resulting in significant new business opportunities for us, improving the supply chain, particularly as demand is improving. And we see it live on the news every day on why that demand is improving. We're in a position to really drive significant supply chain value in what we're already doing. So we announced the Defense Advisory Board in North America. We announced a partnership in the UK, Taurus, where we're partnered with Amentum, who's a large defense contractor, with Maersk and Accenture. We're providing, we're working to provide services to the UK government through that consortium as well.
I got to imagine that's huge for you guys. I mean, considering the Defense Production Act that Donald Trump, the executive order, this new defense bill, which the numbers get tossed around, they're still trying to get anything done from Congress is always challenging, but the number is as big as 1.5 trillion, 85%.
That's the number. That's the number we used. Yep, that's the exact number we used, and that's a good TAM.
Yeah, it's a good TAM. You get your piece. Everyone, and look, as sort of like I think military defense is sort of back in vogue. It's okay to be proud of the American military again, and rooting on U.S. forces. It feels good to help that story. And it's critical because global military spending is increasing. Obviously, we have adversaries in China that we are, even if we're not adversaries, we're at least rivals. So as they increase their investments, we've got to do it. So I'm glad to see companies like yourself are leading the charge there.
Well, we're not shy about it. We're really proud of the U.S. military. We're proud of the U.K. military. We have big business in the U.K. We operate in a number of different countries in Europe. I'm proud there. We have thousands of veterans that work for GXO. We have thousands of people who are involved in this agenda every day. We're not afraid to reach out for outside help in terms of the advisories. We passionately want to be part of the solution.
So Patrick, since I've got you here, I'm going to ask you a question. Your sister company, or I don't know how it's structured, but someone that's in the same building as you up in Connecticut is exposed to the building materials sector. You haven't mentioned that in your comments. Obviously, we watch the housing market pretty closely here. What are you hearing, even if it's just in the hallways of what Brad's seeing? Anything that you can share in terms of prognosis on the overall housing market and building sector?
Yeah, I think they're in a separate building, so I don't hear anything from them.
Walled gardens.
And there's a big garden in between us, and they've got their business to run. From our vantage point, the consumer continues to be strong. We're hopeful for lower interest rates generally for our economy, and I thought the CPI report yesterday was great support of that. The manufacturing index, I think, is great support of that. The economy continues to be very healthy. That's what we're seeing through the end of the year. So hopefully we can be on the right trajectory for interest rates, which only helps housing. Certainly helps our business from a retail consumer perspective for those things around housing. The only thing I could say about the neighbors next door, QXO, is I heard recently somebody say, don't bet against Brad Jacobs. And being a part of a company that was a Brad Jacobs company, I am 1,000% behind that notion.
Well, we're fans
as an investment thesis. Yeah,
we're fans of Brad. We've had him on the show. We've had him to a couple of our events. In full disclosure, have invested in QXO before it went public. I am curious with the sort of legacy XPO business, and you guys have all broken and doing your own thing. Are you guys collaborating closely, or is there a little bit more competition than perhaps there were a couple of years ago? How do you guys think of each other in sort of the mix?
Yeah, I would say there's no competition. None of us are in the same business, and we're separate companies, but we love to work together where we have the right solution, just as we love to work together with other partners where we can put the right solution. And I think it's very safe to be reaching out to Mario and Drew and getting great transportation solutions from them, whether it be the brokerage or LTL. And we're first in line for that. They provide great service, great cost.
Well, we've had Drew on
that
yesterday.
I can answer. Yeah.
We had Drew on yesterday. He's a frequent frequent guest in FreightWaves Today. He might have actually be the Steve Martin of FreightWaves Today. Coming on, Steve Martin on Saturday Night Live.
Like regular guest appearance?
Regular guest appearance.
Right.
So,
Most appearances on.
most appearances, we need to give him an award. Actually, that might belong to our next guest, Bill Stevens, who's technically an insider. I don't know if that counts, but we're going to get the rail report here shortly. Well, Patrick, really appreciate it. Best of luck for the as you guys close out the year. Hope to have you
congratulations.
on next quarter.
Yeah, and congratulations on your 5-year anniversary of being public in Q2 and growing revenue.
Yes, absolutely. Thank you much for having me on, and look forward to talking again soon.
I appreciate it. Thanks, Patrick. Well, we're going to get to the rail data. You've been waiting for it all week. I know I have. And the person to break it down is Train's editor, Bill Stevens. We'll be right back with you.
In freight, again, your customer experience is everything. Every quote, order, and status update is a chance to win or lose a customer, but that will still, again, run on manual disconnected systems. Pallet is the leading enterprise AI built for the supply chain, automating costly operations from code to cash across brokerages, carriers, forwarders, shippers, and warehouses. Mallory Alexander serves 3 times more customers per operator, deliver an exceptional customer experience at scale. Visit them right now at pallet.com.
The world doesn't wait, so neither do they. Wheels on the interstate, boots on the site, hands on the shipment. We build for the world out here, and we build it with the people who live it. Ideas from the field, made real by world-class R&D to keep the operation sharp, the front lines safe, and the world moving. From one cab to a global network, billions of miles, trillions of data points, every one making your operation better. And we never build it alone. Samsara, built with operators.
Once a year, the entire freight industry stops what it's doing and comes to one place, Chattanooga, Tennessee. This is F3, the Future of Freight Festival. It isn't just a conference. It's the largest festival in freight, built to pull you all the way in. The energy, the ideas, the atmosphere, and the people who move this industry forward. Over 50 speakers, 4 events across 3 days, founders, executives, innovators, and disruptors, all under one roof, all asking the same question: what comes next? On the main stage, the sharpest minds in freight take on the biggest questions in the business, the trends, the technology, and the forces shaping what's ahead. Then the clock starts. 7 minutes, no exceptions. The cutting edge of freight tech goes head to head, live, battling for best in show. When the time's up, the lights go out. And in between, the conversations that don't happen anywhere else. The connections that change the trajectory of your business. The relationships you'll carry long after you leave. Because when the sessions end, the festival begins. Live entertainment, unforgettable experiences, a celebration of the world of freight, and an energy you won't find at any other event in the industry. The leaders you need, the access you won't get anywhere else. This is where knowledge is shared, where deals get done, where the future of freight gets decided. F3, Future of Freight Festival, October 27th and 28th. The Signal, Chattanooga, Tennessee. We'll see you there. Register now at live.freightwaves.com.
All right, you've been waiting all week. I know I have, for Bill Stevens' report, sponsored by Trinity Rail. Bill, what does the AAR data tell us about the economy right now?
Well, the trend is holding where things are looking up still compared to last year. North American carload traffic was up 3.9% for the week, while intermodal traffic was up 3.3%. All in, that gives us an increase of 3.6% for North American rail traffic for week 31. Carload growth was higher in week 31 than over the past 4 weeks at 3.9% versus 1.5%. And intermodal volume growth also was higher at 3.6% for week 31 compared to 2.9% over the prior 4 weeks. Turning to the U.S., carload traffic was up 1.7% last week, while intermodal volume was up 4.1%, giving us total U.S. rail volume growth of 3% for week 31 compared to a year ago. And carload growth was stronger than the flat volumes that we've seen over the past 4 weeks. And if you strip out coal, U.S. carload volume was actually up 4.7% for the week. So a much stronger growth trend there without the drag of coal.
So
and
Bill,
intermodal was...
Bill, that's a huge, strong number. 4.7% is a big number when you strip out coal. It's like the ISM data does suggest that the across the economic recovery is broadening. Is that what you're reading into the data?
Yes, and this week on Monday, the AAR released its rail industry overview, which takes a look at the prior month's economic and rail traffic indicators. And July carload traffic was up 3.2% when coal was excluded. Intermodal had a record July and was up 6.1% compared to a year ago. And that was the 7th straight month of growth for carload traffic. Intermodal was up for the 6th month in a row. And as I mentioned, set a new record for July. And the AAR's Freight Rail Index, which measures seasonally adjusted volume excluding coal and grain, was up for the past 4 months and currently sits at its highest level since 2008.
Which is
and the
absolutely insane when you consider the fact that, this is the bulk of the, no pun intended, this is the bulk of the industrial sector. That's what this data tells us, just how strong the industrial economy is. And look, it's encouraging. We've been talking about AI data centers earlier in the show, but the fact that this is broadening beyond AI data centers to other sectors, I think is really promising.
Yeah, and AAR says that manufacturing and rail activity are moving along together. The manufacturing is expanding at a pace not seen in several years, which underscores the close link between factory output and rail volumes.
Yeah, and intermodal, we've talked about it because there's been I don't know if the right term is softening in truck volume, but certainly a normal seasonal slowdown. Maybe caught a little people off guard because the momentum we saw strong momentum earlier this year. It's paused for a bit. And I think the question is what has been happening. We broke down the data in some of our updates. It's really intermodal has picked up so much share. And it takes a couple of months. This, Bill, is that, once companies want to explore intermodal, they need sort of a sustainable belief that the economy and capacity is going to be tight. That's when they start taking advantage of a 34% discount between intermodal and truck, and that's what we're seeing.
Yeah.
What's that, Julie?
I said yes, 34%. I mean, how do you not try to take advantage of that?
Why wouldn't you? It's a huge discount.
Yeah, and this was a month, too, when rail traffic grew faster than overall GDP. We haven't seen that in a long time. AAR didn't point out exactly when the last time was that rail traffic grew faster than GDP. But if you look over the last decade and just take it as a whole, rail has massively underperformed GDP, and it's been more in line with industrial production.
And Bill, is that just because over the last couple of decades, services, government has been a bigger portion of GDP, and therefore the industrial sector, it's really 2017, 2018, sort of the last industrial recovery that we had, and then it sort of paused in 19. You have that trade war noise that was overhanging, you had COVID. This is a recovery really since, over 10 years ago, hasn't it?
Yeah, that's part of the story when you look at rail volumes versus GDP. So much of it is not goods related. It's services, it's the financials, it's travel, you name it. If you can't put it in a truck, in a container, in a boxcar, it basically doesn't count because it's not freight that you can move. And you look at, tech, for example, you're never going to put apps in a boxcar and send them out, right? But industrial production is a far better measure, economic measure overall to compare to rail.
Well, we had
rail
GXO's
volumes.
CEO right before, I think you caught the part of the segment, Bill. And one of the things that he commented was that they are seeing reindustrialization happen. It is real, but it's happening in places that is not normally sort of the core freight growers. And we've talked about the fact that the intermodal volume has shifted. The East is doing better relative to what it had been. J.B. Hunt was constructive on a change in their network. It really feels like it's that Chicago, Atlanta, almost north-south traffic versus what has been the legacy west to east traffic is really starting to win out.
Yeah, that is where growth is occurring, but it's also smaller. The bigger intermodal lanes, is still Chicago to the East Coast, and just by volume, and that's a mature lane, relatively speaking, and the north-south lanes are a little bit newer by comparison, and there's some new services offered as well between Mexico and the Southeast, and also the Mexican industrial areas up to Chicago. That are very competitive now.
So I thought one thing was really, really telling when we were, and I mentioned this yesterday, but we used to only compare long haul transportation volumes to intermodal to see where market was shifting. Yesterday, I compared just the overall truckload volume index with loaded container volume, O-rail, and looked at just the last 3 months where we've really seen this shift in mode, and it literally came up with exactly the same numbers that
what does that mean, Julie?
The truckload volume index was up exactly 4.4%, and rail volume was up exactly 4.4%, which is why we're not seeing more demand on.
Zach did a great article on this week. I called Zach on Monday. I'm a newspaper man these days, in addition to doing all the other stuff, and so I was a little distracted last week, and I was like, what is going on with accepted truck volumes? And he was pointing out the intermodal, and he had done a great article on it on Sunday or Saturday, which was the chart of the week, which he publishes. And his comment was his intermodal. And you look at the data, it's absolutely there. So real quick, I have if you trust Grok and AI, I asked Grok, when was the last time, Bill, that we saw bulk rail volumes increase faster than the GDP number? Do you want to take a wild guess?
Oh boy, I'm going to go with 2013.
Nope. According to Grok, it was before the Great Recession. So really, 2008 was really the period where you did have more bulk. And if you think about that, that makes sense. I mean, a lot of what drove economic activity from 2008, from the financial crisis, was a lot of money printing, services, government was an outsized share of economic activity, financial services as well, where a lot of the core industrial sector and goods economy did not keep up. I mean, even if you look back at the trucking data from 2010 to 2014, it was very slow. It was a very slow recovery. I mean, this is one of the things that people have talked about with QE, is the reason, it was such an overhang. It was just printing money, and that inflated asset prices, but it didn't necessarily help the common man. And that's, I think that is sort of proved out in the data. It is interesting because you're seeing a shift back to goods production, manufacturing, and also what took place in 2008 was really the Chinification of the industrial economy, of the manufacturing sector. China really didn't, their economy didn't slow down very much during the financial crisis. They picked up a lot of share as companies got real desperate to cut costs. They were the primary beneficiaries of that.
Yeah, and the other thing that was going on during that time period is, rail traffic overall peaked in 2006, and coal traffic really started its decline then, around the 2008 period, especially as fracking came in. We got low-cost natural gas. It becomes more attractive for electricity generation than coal, because the utilities are going to use the lowest cost fuel. And so that's a big part of the story as well.
And you can't hold natural gas on trains. I asked the regulator, I was at an event, it was an energy event, and I asked the regulator that why, it was with DOT, and why, and he's like, there is a perception that you don't want natural gas trains running. He's like, but it's on the roads. So he made the case, but I guess there's all these sort of beliefs, this NIMBYism that we've talked a lot about here, Bill. Consumers are not educated on how supply chains work, and therefore they want to, they don't want these things coming across their communities. So, Bill, I want to talk a little bit about some of the other stories that you've been covering. Tell us what is sort of top of mind in terms of the train community. What are they thinking about these days?
The big thing today was a court ruling that has come out that upheld the Federal Railroad Administration's two-person crew rule. The FRA came out with that in 2024, and several railroads and the AAR and the Short Line Association sued, arguing that it was arbitrary and capricious and beyond the scope of the FRA. A U.S. District Court upheld the rule and said it is within the FRA's purview. And so it's unclear what happens next, if there'll be another court challenge or if this is the end of the road for it. But it's interesting that this comes at a time when the DOT, the broader DOT, is bending over backward to try to encourage the development of autonomous trucks. And, the railroads would tell you that this is not modal equity, that having a two-person crew rule basically binds the railroad to the past and doesn't allow them to consider other options like a one-person crew with a roving conductor or autonomous operations down the road.
So we know under the Biden administration, the FRA was, had supported the two-person crew rule, but under the Trump administration, is it still the case that the FRA wants a two-person two-person train?
That's an interesting question, because both Republicans and Democrats are trying to appeal to the unions these days.
I know, right?
Joe Biden made it a campaign promise. There was a YouTube video he had directed at the rail union saying, "We will get you a two-person crew rule," and he did. There was a rule that was proposed in 2019 when the first Trump administration came in. They got rid of that and said there wasn't the data to back it up. And so the political pendulum swings, and we get two-person crew rule, we get no two-person crew rule, and now we're back to two-person crew rule. Where it goes from here, we'll have to wait and see.
It is interesting during the election, at the Republican National Convention, that you had Sean O'Brien, the head of the Teamsters, keynoting he didn't, by the way, go to the Democratic. Did they even have a convention? Because that was that whole election cycle between Biden and Kamala. Was there even a Democratic convention? I don't remember.
There was a Democratic convention, yes, but it was weird because of the whole late entry.
It was such a weird election season. But Sean O'Brien was the keynote for the Republican convention, which was, the Teamsters have been at odds with the Republican and the GOP for decades, and it was interesting that because the rank and file largely supported Donald Trump. I mean, his whole platform is industrial jobs, all that stuff. The rank and file was supporting him, and yet the Teamsters historically had been very pro-labor. And I think the United Auto Workers were also were doing it. But it is interesting to watch, as you point out, Bill. The Trump administration has a populist view and is trying to embrace unionization in some ways.
That's correct. It'll be interesting to see. The FRA is working on streamlining regulations and making it easier for railroads to adopt new technology like autonomous track inspection, autonomous equipment inspection, and perhaps ultimately autonomous trains. There's a pilot program going on right now on a couple of short lines in Georgia with Parallel Systems testing their autonomous container car that's battery electric.
And you had a great interview at our Future Rail Symposium on autonomous rail. So you certainly covered it. What else should we be watching? Anything on passenger that's sort of top of mind?
Amtrak is kind of having a little meltdown in the Midwest. They are having problems with locomotive availability. We're looking to get into the bottom of that. I just filed a Freedom of Information request with Amtrak on Monday morning, first thing, to find out a little bit more about what's going on because they have not said much.
How's our friends in Florida doing? Are they going to make it?
Brightline, so far they're on the right side of the grass. What happens, in another month, we'll see. I'm not sure when the next deadline is for their refinancing, but
I hope they survive. It's a case of private funded rail. Florida, people that live in Florida swear by it. But some of them say, "Hey, it's easier to drive and get on and off," but it still is a case example of, you talked about this, Bill, is that there's been a continued increase in passenger traffic. But unfortunately, these things are very capital intensive, requires a lot of debt to fund it.
Yeah, they are indeed. And so are roads, though. And there's a cost to driving and a hassle. I would rather be on a train, all things being equal, if it's competitive with driving time. You can sit there and do work, look out the window, have a glass of wine, whatever.
Bill, is that just because you like trains, or is that like legitimately?
Everything you just said sounds pretty.
I mean, he does sell it. Although the trains I've been on, I don't know, man. Sometimes, even taking you get motion sickness.
So bad.
My wife does that too. But even going from the city to DC, it's like a 5-hour trip.
Oh, I don't know. I took the train all the time.
And I know
as long as I was sitting forward, I was okay. If I ever got stuck sitting backwards, I was effed. I felt terrible.
My wife did that trip from the city from New York to DC with the kids, and she's like, "No, I'd rather fly."
All right, Bill.
Because of just the luggage and doing it. So I don't know. I mean, there's a bunch of rail fans that don't like that statement, but
I don't know. Amtrak, they still wear the white gloves. They have. I don't know. I think it's kind of a nostalgic, fun, glamorous experience. Sometimes
it's super cool.
Sometimes it's not. But
the reason we have such a robust aviation network is because it works.
Yeah. All right, Bill. Every week I learn something I didn't know about trains. So teach me something.
Today, right now?
Yeah, anything.
Oh boy. Well.
I know I put you on the spot. That's a hard one because it's so broad.
Yeah. It is. Yeah. Brightline will be interesting in Florida to see if that can survive because Amtrak is a monopoly operator. They are the only intercity passenger operation that's permitted. This, of course, runs entirely in Florida, so it's okay. And the new Brightline West, which would be a true high-speed route connecting Las Vegas to the Los Angeles area, that will be a game changer if they're able to get that built and have 186-mile-per-hour trains running between LA and Las Vegas.
Well, I think
that would be worth it. Think about all the traffic that you wouldn't have to deal with.
Yeah. I mean, and all those casinos and Nevada state taxes could help pay for that. Bill, I always enjoy it. When you ask that question, it reminds me of my son speaks Spanish because he's bilingual. It's almost asking the equivalent of say something in Spanish.
Oh, I know, it's too broad. Either I learned something about the mechanics of a train or about train masters. Every week I learned something from him that I didn't know about it. Yeah.
Bill Steven. That's why we have him on every Wednesday.
Now next week he'll be prepared with one. I won't catch him off guard. Teach us. Keep teaching us.
Yeah, exactly. I'll come with a lesson plan.
Well, we're excited to host you. Stay with us. We'll be right back with Jeff D'Angelo, the CEO of Furai. He's going to talk about an AI-driven acquisition of logistics businesses. We're going to hear all about that.
In today's supply chain, every mile and every minute matters. Shippers, lessors, and railroads count on performance they can trust. That's where Trinity Rail delivers. With integrated railcar solutions including manufacturing, maintenance, parts, fleet management, and leasing, helping you reduce downtime, optimize your fleet, and stay ahead of demand. Because efficiency isn't a goal, it's a competitive edge. Trinity Rail, built to deliver.
The world doesn't wait, so neither do they. Wheels on the interstate, boots on the site, hands on the shipment. We build for the world out here, and we build it with the people who live it. Ideas from the field, made real by world-class R&D to keep the operation sharp, the front lines safe, and the world moving. From one cab to a global network, billions of miles, trillions of data points, every one making your operation better. And we never build it alone. Samsara, built with operators.
Once a year, the entire freight industry stops what it's doing and comes to one place, Chattanooga, Tennessee. This is F3, the Future of Freight Festival. It isn't just a conference. It's the largest festival in freight, built to pull you all the way in. The energy, the ideas, the atmosphere, and the people who move this industry forward. Over 50 speakers, 4 events across 3 days, founders, executives, innovators, and disruptors, all under one roof, all asking the same question: what comes next? On the main stage, the sharpest minds in freight take on the biggest questions in the business, the trends, the technology, and the forces shaping what's ahead. Then the clock starts, 7 minutes, no exceptions. The cutting edge of freight tech goes head to head, live, battling for best in show. When the time's up, the lights go out. And in between, the conversations that don't happen anywhere else. The connections that change the trajectory of your business. The relationships you'll carry long after you leave. Because when the sessions end, the festival begins. Live entertainment, unforgettable experiences, a celebration of the world of freight, and an energy you won't find at any other event in the industry. The leaders you need, the access you won't get anywhere else. This is where knowledge is shared, where deals get done, where the future of freight gets decided. F3, Future of Freight Festival, October 27th and 28th. The Signal, Chattanooga, Tennessee. We'll see you there. Register now at live.freightwaves.com.
Welcome back to FreightWaves Today. We're going to talk about a roll-up strategy that's different than the typical logistics roll-up. With us is Jeff D'Angelo, back to FreightWaves Today. He is the CEO of Fura. Jeff, we teased this big announcement. What is the announcement?
Which one?
The notes said
Which
you had a big
announcement?
announcement.
The high rise.
Yeah.
High rise acquisition. Yeah, it's our 7th acquisition over the last couple of years. High rise is based out of Washington, and it's part of our roll-up strategy to buy up sort of small and mid-sized freight brokerages and use AI to automate as much as we can, but also to provide an amazing experience for customers, which both sort of go hand in hand with the AI roll-up.
All right, Jeff. So I want to ask more about this and why High Rise was the right fit for this deal. But where's Birdie today?
Oh, you remember. I don't know where she is. This is probably the first day in a long time where she hasn't sat on my lap. Maybe the kids next door took her.
She's enjoying her life in another room. So tell us, why was High Rise the right fit? Why were they who you looked to be your 7th acquisition?
Well, if you start with the market, we're one of, I think Craig just said it, like we have a very different roll-up strategy. A lot of roll-ups will buy larger companies, right? They'll buy 50, 100, $200 million companies as a way to stack revenue. For us, we look at the small to mid-sized players, and because we've had so many exits to market over the past few years, these companies are, fraught with debt. They a lot of times don't have the right technology or the right go-to-market or the resources, and maybe they don't, pay carriers fast enough. For us, once we bring them over to our platform, we instantly sort of raise the opportunity for the team. And in this case, the team is fired up. They're excited about joining Fura to have an extra set of tools to go to market with and allow them not to have to do a lot of the manual work.
So in these acquisitions, what is the average timeline to get Highrise or choose an example of one of the other 6 onto your Fura platform?
So we obviously have a playbook for this, and it's very, very simple. AI. So several years ago, 10 plus years, 12 years ago, I started a company called Turbo. And one of the biggest challenges we had was adoption. Turbo was a network application. You could sort of share the platform with your customers and your carriers and get leverage from each one, but adoption was hard. The good thing about AI, the great thing, and timing is everything, is that we don't necessarily need adoption to get significant leverage. So the 4-step process is, especially with diligence being under a microscope, is the first thing. So we have to do a ton of research around, the carrier setup, carrier engagement with these companies that we buy, because a lot of times the small to mid-sized companies don't have the resources or haven't built compliance from the ground up. So we spend a lot of time there. The second thing, which is once we acquire them, we wire up the business on day one. And we can do that with AI already on day one. So what I mean by that is you can't manage what you can't measure. Everybody's heard that. But a lot of these companies don't have standardized data. They don't have structured data to make decisions. AI has come along and allowed us to have unstructured data, but I can see everything from how many offers we get, what the quotes are, what carriers are sending, offers on shipments or capacity. All of that is instantly brought into our database, and we start recommending quotes to customers. We can auto quote the customer, which we already do. And so wiring up the business is really important for us to understand where the upside opportunities are for the business.
So, Jeff, I'd like to break
And
down.
then, and real quick, so part of the other step, sorry, Craig. Step 3 is really allow our AI agents to do a lot of the work. Almost 40% now of our booked carriers are done through an agentic AI, whether it's email, text, or over the phone, inbound and outbound. We even, as part of compliance and shipment creation, and a lot of the sort of manual work that's done today by human, sort of shifts naturally and organically to AI. And then 4, which is really, really important, these small to mid-sized brokerages will have small to mid-sized shippers. A lot of those shippers don't have technology, and we give them our tool set as a way of operating with them and providing world-class visibility. So the one thing we actually do the best is visibility. We provide visibility, and I could go really deep into that, but it's kind of like FreightWaves. FreightWaves does one thing really, really well, a lot of things well. But one thing is you own the best data set, the cleanest data set, and you provide more data to this industry than anybody. And so that's what we want to do is take that sort of example, but do it with something that actually adds value to the customer.
I appreciate that, Jeff. I want to talk a little bit about the type of deal that you guys did. Let's use this Highrise business, because I'm always intrigued with M&A. We're doing our own roll-up in media acquisitions. And so personally, I like small deals. I know big private equity funds hate small deals because it's hard to get the leverage in the 4-year to 5-year time frame that you need to get big. And so they're all about return on time as much as they are return on investment. The thing I like about small deals is the failure, if you're wrong, is so small, it's not going to kill you. Whereas the big stuff, the highest return investments we've made are the big deal. I mean, lowest return investments we've made have always been the bigger deals because you're paying more for them. The small deals are just amazing. How do you think about transactions when you're approaching them?
Let me answer Julie's question first, because I don't think I fully did. It takes us about a week to onboard the new businesses. So I remember Brad Jacobs used to say it takes them about 2 years to integrate. It takes us about a week because the technology does a lot of the work. How we think about these businesses are, a lot of these companies have great relationships, right? And relationships matter in our industry. They have great customer bases. But from an acquisition perspective, we obviously don't have to pay as much of a multiple for those companies. In a lot of cases, the owners want to see the upside more than the upfront payment. They want to be a part of something. And you've got a couple different types of owners. You've got the people that are sort of leaving the market because they've been in the industry for a long time. They're approaching the age of retirement, and they just want to see their company and the people that work for them be a part of something that maybe they wouldn't have the opportunity to do. The second kind of company that we're engaging with, which is why PE and some of these companies won't touch, is not just the size, but it's the fact that they might be breaking even, close to breaking even, or losing money. And in those type of deals, obviously the owners are not going to get the value that they probably want until the second bite of the apple, which is the upside as a part of the Fura platform. And when I say platform, I don't just mean technology.
So Jeff, are we thinking sub 10 million revenue businesses are kind of ideal for you guys, or what's the type of deal if someone's listening to this show and they're an owner of a small brokerage? Where is the sweet spot for you guys in terms of how you sort of think about where to play?
Sub 30, I would say. Sub 10 is very quick to onboard. It's a week. Some sub 30, depending on the profitability of that company. I'll give you an example. It not only is it pretty simple to onboard, I would say we have that playbook, but it's once you start getting above 30 and 40, they've got some issues that are harder to unwrap, I would say, untie, and not saying it can't be done. Like we have deals that are really, really struggling. There was one deal in particular we did a couple of years ago that when we engaged them, they were 26 million and they had about 30 people. And then when we acquired them, they were around 12 million in top line. And, we realized that, with our automation that we wouldn't need that many people, but we brought the owners along as part of the engagement and as part of the upside. And that business has grown from 12 million to over 30 million.
So it's back to prosperity. I am curious, Jeff, having done M&A myself, every deal I learned something and I'm like, man, if I had only known this. And it feels like every single time we do a deal, a thing that has gotten us, and we don't make the same mistakes again, we just make new mistakes. Working capital always is the one that is the hardest to get right because everybody defines payables and receivables slightly different, billing cycles slightly different. That always seems to be the one that is the most difficult to sort of nail down. It's getting easier with AI, but it's still a challenge, at least in media circles. What is the thing that you wish, if you could just hone it in, that keeps biting you? What is that one thing when you have M&A that is a consistent problem for you guys?
You mentioned working capital. You're absolutely right. That's one of them. I think the challenge is a universal definition, and at the size of companies we're acquiring, the owners a lot of times were salespeople that started the business because they had a relationship with a set of customers, and not necessarily finance people. And so they might be learning, because it's the first company that they're selling, what actually the definition of working capital is. Yeah. And so getting that alignment is very, very important up front, and defining it up front. And actually, we spend a lot of time on that. I think for us, one of the challenging things is, cultural, right? Like Fura has a culture where its leaders have spent time in both tech and logistics. And so the DNA that we've sort of spread throughout the organization is very different than what we're acquiring historically. And so there has to be a lot of trust earning up front to get people excited about what we're trying to do, and then changing old behaviors, because our sales go to market is very different than traditional freight brokers. Getting them to change behavior is still another challenge for us. And if I could snap my fingers and have everybody adopt on day one, I'd say that's probably the most important and effective thing, because I could do 50 of these a year if it was much easier.
Jeff, you're
Yeah.
speaking. I mean,
Cultural alignment, and
cultural
change
is
management.
hard, and you know it is. It is. Everyone says it, and it's somewhat cliche. I think we've learned the hard way, and I don't know how you guys think about it, but when we do a deal, we used to try to accommodate the teams and the culture, and try to I wouldn't say evolve our culture around their business, but certainly not be as proactive in terms of, hey, these are the expectations, and not everyone's going to be here. Now our playbook is much more prescriptive in terms of this is the way we're going to do it, and this is not for everybody, and that's okay. I don't know how you're thinking about it right now.
Oh, you have to standardize. Everything we do, we standardize to make it easier to scale. And so the first thing we do is when we buy a company, and we just met with the team a couple days ago, we buy a company, we sit everybody down together. So everybody hears the same exact message. And we say, this is who Fura is. This is how Fura employees act. We act like owners. We have, obviously values that we interact with, like best idea wins. I do not like red tape, right? I want people to fail but use that failure to succeed. But the thing I tell everybody is I have to earn my job every single day. I have to problem solve every single day. I have a board, right? And I expect my team to feel the same way, but not in a negative way. We have to foster that sort of engagement and that culture continuously, but expectation setting on this is what we do, this is how we do it, but let's start with the why. This is why we're doing this. I think for me, it's the most important thing, and for our company, it's the most thing to get people to transfer over. Do we have laggards? Sure. We have people that adopt late, but the high-rise team, when we bought them, that night, they all changed their LinkedIn. They were all excited. I was getting emails 10, 11, 12 o'clock at night from the team, and they were very, very excited.
That's great. It's always a relief when you walk in and you have welcome with embrace. I've seen the opposite, where you get the opposite. And that is always challenging, because at some point you're like, the business has got to move forward, and the direction's changing. It's a painful process. But the nice thing, Jeff, is there's so much valuation arbitrage in buying smaller businesses, particularly as you implement technology. What are the improvements that you guys see in a small business? What would they expect to see in terms of operating improvements?
2 to 10x in EBITDA. That's kind of what we've seen. Our SG&A costs are between 35 and 40%, which the market is anywhere from 65 to 85+%, in some ways up to 100%. And so a lot of the improvement is just unblocking, taking one person and making them sort of the value of 10. That company we bought a couple of years ago had 26, 30 people, and now they have 6. Like, that team has 6. Not saying we want to strip everybody, but like the technology does a lot of the work, and we give everybody the opportunity to shine. Some of those are, impact culture negatively, and we're gonna sort of take care of that. But the leaps and bounds of what we're able to do is really focused on a growth story, not necessarily an EBITDA story. And a lot of the EBITDA story is about growing that revenue. And so to us, that's the most important, not only to foster the culture, but also to excite people to want to fight for this business and fight for the change in our industry.
Well, if you don't do it, the issue, Jeff, these businesses of 30 employees and 12 million revenue, if you didn't buy them, they're probably not going to be around. Not only would you lose the 24 employees that you lost, but the whole business would go under. And I think the reality is, look, it's true in media circles too. The stuff that we're buying, and I always tell people this, whether it's, they want to hear it or not, is media businesses, because these are prestige assets, are not typically being sold when they're at the top of the game. They're typically being sold when there's significant problems and challenges in the business, particularly operating. It's just the nature of the way the business works. And oftentimes you're having to do the work that someone else didn't do and could have done, and you're having to make the hard decisions.
Yeah, there's a reason why a lot of these companies are under 30 million, right? And the companies that have been successful, 88% of the revenue is coming from the top 1,000 sort of brokers in our industry. And those brokers a lot of times have figured out the number. I put a quarter in, I get 2 gumballs out. The ones under 30 million or so haven't. They haven't figured that model out and have a tough time scaling. In some ways, they might have multiple businesses, and this is just one of them. And so, going back to multiple arbitrage, yeah, like we can buy them at very low EBITDA, but what we can do to those businesses are things that they couldn't do themselves. We grew over the past 2 years from 10 million in revenue to over 100 million in revenue. And 50% of that was organic growth, not necessarily acquisition growth. So these are small businesses we're buying. But at the same time, we're turning those into sort of larger ones. And I think as we scale this business, this is a many billion-dollar opportunity to sort of supercharge businesses that couldn't have done it on their own.
I love this playbook. I mean, I'm so enamored with.
So we don't have much time left, unfortunately, but I have 2 questions that are sort of related to each other that I want to make sure we get to. So one, why is Fura a better option for these companies than being like a brokerage agent for someone? And then 2, for these small guys who have this liability risk in a post-Montgomery world, what does the AI compliance that you're offering do to their risk profile versus having maybe a compliance person or some sort of loose process?
So the first one was, I'm sorry, I was so enamored with the.
Why sell to Fura versus being
why to sell to Fura
somewhere else?
So I don't want to talk bad about anybody. I think there's a lot of great businesses out there. I don't think anyone has the stack or the DNA we do from a technology perspective. We're not for everyone. Like some people just want out, and want as much money up front as they can. Some people, just want, they have buddies in the industry who say, hey, just go to my buddy. But for us, it's about finding the right fit. And it's really with owners that want to sort of revolutionize their structure, their technology. They want to give tech to their teammates that they want to see them thrive. And I think, a lot of agencies, they just kind of put people on an island with or without support. But for us, we support even our agents. We have a couple of agents that we've added, and we try and supercharge their business exactly like their employees. And the standardization, right? Like we love standardization of everything. And so, risk profile, again, a lot of these small to mid-sized brokerages don't have the resources to, get a highway or get a gen logs or or do real-time integrations or do real-time checking. And, when we get into the details of these companies, a lot of times it's a human going to SaferSys and some of these other tools and, doing this to the wind saying, I think they're good. Now with Montgomery, it becomes a foundational element of being able to compete, I would say, in the market. And if they're not doing it, shippers are in a lot of ways walking away. And we started from the ground up, and then we added, sort of AI to help us with that. And AI for us is about speed, right? We actually check for every shipment programmatically. We do have a person that sort of blesses at the end, but the speed at which we can check is seconds, not hours, right? Or not, 10, 20, 30 minutes. It's really seconds. And speed for us is the difference between booking a truck and not booking a truck. And that, speed is everything.
Well, Jeff, we're out of time. Man, congratulations on a model that seems like it's got a lot of promise for you. and quite interesting. I'm a big fan. Thanks for coming on FreightWaves Today and sharing the story with us.
Thanks, all. Appreciate it.
So tomorrow on FreightWaves Today, Nicole Portello. She is the Senior Vice President and Chief Digital Officer of Volvo Trucks North America. So many questions about the future of the truck, the future of powertrains, the future of autonomous, AI. All of that's going to be talked about tomorrow on FreightWaves Today. Tune in at noon. We'll see you then.